underway, and ahead of what will be a significant and busy day for a number of different reasons. The Dutch election ongoing, voters hitting the polling booths already through this morning and afternoon, results due overnight. We'll touch upon that in this briefing in a bit more detail. Then of course you've got a slew of important tier 1 economic data coming out of the US, and then that leads us into the FOMC rate decision, the updates on their forecasts, and then Fed Chair Janet Yellen will be giving her presser as well. So quite a long day ahead, and multiple things to discuss here this morning, so I'll try and talk about those in as concise a fashion as possible. But looking at the charts this morning, obviously the thing that jumps out when I first sat down was, why did the pound spike just after 6 o'clock? Kind of saw similar spikes of volatility yesterday, and we're seeing it occur this morning as well, around the same time as when Europe really came into market a few minutes after 6. About a 10-minute period, it ramped up quite quickly. Couple of things that people have been pinning that on, a few press articles about the Scottish referendum, about the shadow MPC, and we'll have a look at what some of these things mean and what weighting I'd give them to that move. But certainly cable on the front foot this morning, as to really are both major pairs. Euro dollar is also up around 21 pips here, and on top left of my charts as the dollar index sits down about 0.25% ahead of the Fed decision later. So cable seeing a bit of outperformance. Elsewhere, gold's pretty flat, as to our treasuries. In equity markets, we're off to a fairly positive start in the stocks, with the DAX having broken through that 12,000 in the futures, which it briefly opened just below when we got underway in the Eurex Open, busted through there through the cash open, bit of a surge in volume, also just breaking then those respective highs which really defined the afternoon session from yesterday, taking us on a quick look at that R1 on the upside. Oil as well up, obviously taking a bit of a recovery from the perfect kind of U-shape performance from yesterday, and we'll have a look at that in a bit more detail as well when we start talking about the news that's come out. So let's get underway then. A few things I want to talk about on the Dutch front. Firstly, if I just transition my screens, and obviously they're now underway. Today is election day. To give you an idea, the exit polls will be available soon after the polls actually close. In terms of our time, that will be 9 p.m. this evening. So exit polls will come shortly after the close. The latest poll suggesting established parties have slightly gained ground at the expense of the right-wing PVV, so that's that Geert Wilders party, and other Eurosceptic parties as well. So putting in a bit more context in terms of actual seats in the lower house in The Hague, so it makes a bit more sense if you start to hear numbers thrown around. PM Rutt's Liberals, they are set to take about 27 seats in the 150-member lower house. That is down from 41 seats from the last election in 2012, but would put them in first place. This compares to around the 20 to 21 seats projected for Wilders' Freedom Party after it took 15 seats back in 2012. Rutt and other mainstream parties, we've talked about this before, they've essentially ruled out entering an alliance with the Freedom Party, and then that means then that Geert Wilders' participation in a government is actually quite unlikely. In summary, there's 28 parties contesting the election, with as many as 14 of them forecast to enter Parliament. So a ruling coalition could comprise of 5 groups or even more. Hence the reason why I'd say market volatility around this Dutch situation, although we've seen a little bit of movement in the spread, Dutch Bund spread yesterday, overall it's been fairly contained. Certainly from a forex and equity point of view, it's been minimal interest, I'd say, around this, given these facts of the Freedom Party having any kind of control, unlikely. Even if they were to be an outright winner, the fact that other parties are unlikely to form any type of coalition with them would be problematic for them. To give you an idea as well, I did see a very interesting statistic about Dutch elections. And obviously when people will probably turn after today and will be looking at, okay, how long then to form a coalition, because that's where this is heading. And putting together a government has taken, on average, 72 days for the Netherlands since World War II. And that's always been with 2 to 5 parties in each coalition that's been formed in each government since World War II. So you're looking at really a minimum, on average, 2 months in order before they actually get anything in place. And obviously in 2 months' time, are people going to be really talking about the Netherlands? Well, probably not, because we'll be right in the middle of the French election process, probably completion of the first round into the second round at that point, and that will dominate. That definitely is the bigger risk from a European political point of view. So Dutch thing to be monitored. Obviously I'll have the full results in their entirety by the time we speak again this time tomorrow, so we can discuss that in a bit more detail of what's happened. Just moving on though, this was a headline from yesterday, and this will lead us in then to a quick chat about pound, but some more coverage about it this morning. This is the EU could force Theresa May, the PM, to wait until June to start Brexit talks. So European Union considering forcing the UK to wait till June for formal negotiations. This despite the fact that obviously the government's plan is to trigger Article 50, and what the market is expecting now is between the March 27th and March 30th. So there's going to be a bit of a hiatus there before actual conversations start to get underway. This article I did send out to you this morning. How soon the EU can proceed will largely depend on when May triggers Article 50, and if leaders can hold their summit on the preferred date of April 6th. UK officials say May is eyeing a final week of March, as we said, to get that underway. Up until this point, May has controlled the clock, refusing to activate Article 50. But the UK has the most to lose from not being able to strike a separation deal, handing leverage to the EU when Britain formally says it wants to leave the bloc. So again, maybe from a European point of view, that French timeline that we have as well to navigate, they might well be sidetracked by that should the unexpected occur, and if you had a Le Pen win, and certainly this could start to delay when some of this actually gets underway. But again, this is quite important because obviously the UK, in terms of appeasing the voting public who voted en masse for a Brexit, you know, how long, if I was Theresa May, I'd want to get this underway into talks as quickly as possible, because the quicker that begins, the quicker I can start showing some progress to the general public. Otherwise, you would think that people will become quite tiresome of this issue, and the government's lack of ability to show any type of progression would likely put more pressure on a Theresa May leadership in the Conservative government. So that's something interesting to watch. One of the things then, we've just said we had a bit of a movement in the pound to the upside this morning. If we just flick back to the charts, if you remember, it was around really 5 o'clock last night. We had some selling. Europe came in, at 6 o'clock, and then when the retail kind of market came in, they hit it again yesterday. We've already taken back that entire move. And this is what I've been kind of talking about in the strategy we issue on a daily basis ahead of the US session, is that one thing for sure that's going to pick up, although there might not be a definitive direction of a strong direction to the downside, although I think that will be the overriding move, what is going to happen is you're going to get certainly a pickup in the trading range of the pound, I think, going forward, particularly upon the triggering of Article 50 and those first kind of conversations that the EU and Britain start to have. So when you have movements like this, it might start to become a bit more of a regular occurrence in what otherwise has been a fairly low volatile market overall. And so we've already taken back that sell-off that we had on Tuesday and some. You can see it's probably stops being run there, hence the large size of that wick. But that actual move, if we put it on a minute chart, it occurred a few minutes past 6 o'clock, started to go bid, and then a few minutes later it really started to pick up a bit of momentum. Could have just been, looking at the futures here, pretty thin liquidity, maybe just picking up maybe some of those algo-based momentum, kind of triggering and then taking some of the move higher. A few people though looking at this Scottish situation as potentially a catalyst. I think that's maybe a bit of a stretch. I think it's more just order flow going through the market as Europe came in. But essentially, this is the headline: support for Scottish independence has reached a record level, according to the latest ScotSend survey, but anti-EU sentiment has also reached a record high. So these findings from the Scottish Social Attitude Survey complicate a potential second referendum on independence and underline how Nicola Sturgeon must decouple Brexit from the debate. So a couple of people suggesting that actually she may have been better just to have hold fire instead of being so gun-ho in pushing for this second referendum so quickly, because ultimately it might backfire if she doesn't actually have the support to then immediately join Europe if they actually don't want to be part of Europe. So maybe that then just lends back to a bit of powers to Theresa May that actually it's unlikely that this will ever occur. And don't forget the timeline of this is what Sturgeon was saying is still a long way off. We were looking at autumn 2018 or possibly 2019. So maybe some of that Scottish independence calls, battle cries that we had, which came amid some of the selling earlier this week, just being taken back, and then net neutral, we're back to where we were in terms of cable. Some other people looking at this, and I think this is even more of a stretch if I'm being honest, but some of you might not be aware of who these people are, and so I thought it'd be prudent just to show you. And so the Times saying that prepare ground for interest rate rise, according to the Times panel. Now essentially what you have is there's an institute called the IEA, and they have what's called a shadow MPC, and then the Times newspaper also has their own version of a shadow MPC. So basically it's a replica of the same number of Monetary Policy Committee members as what's on the official Bank of England NPC, and someone like the Times panel is basically comprised of people like ex-Bank of England officials, chief economists at investment banks, head economics editors, so a cross-section of the financial community. And what they will do is they'll hold their own kind of mock Monetary Policy Committee meeting ahead of interest rate decisions at the Bank of England, and they'll give their verdict. And what both the shadow MPC decisions have said is that the Bank of England should prepare the ground for an interest rate rise next month, as according to the Times shadow MPC. Obviously that errs much more on the hawkish side than where the markets are positioned. Some people touting that maybe this was a bit of a catalyst for that move. I think that's trying to pin news to a move, because ultimately the timings don't match either. But just so you guys are aware of that. Be mindful though that when you have things like a shadow MPC, obviously they've got nothing to lose because they have zero at stake. So they can be a little bit more theoretical in the fact that obviously inflation in the UK is rising quite quickly. The obvious move then is to counter that with now starting to get the rate path going up in order to negate inflation running away. That's fine for them to say, but put them in the hot seat, I'm sure they'll change their tune. So that's that. And the pound this morning, again, as I said, we are elevated. That move this morning, I would just take it for what it is, as an order-driven move, pick up in volume, stops triggered, maybe a bit of momentum carrying that move in very quick fashion in what otherwise is a very normally quite a liquid part of the day, exacerbating the move. A few other pieces you could look at then, but nothing really outright that makes me feel like I really want to get massively long that market at this particular point, not in the wake of the Fed coming up, which we'll talk about shortly, which will definitely have some impact for the dollar. Okay, quick look elsewhere. Let's have a look at oil. Some big moves yesterday. First of all, let's just start with a much smaller move, and that was at 8:30. So if I really kind of just circle that part there that you can see, kind of the tail end of that recovery that we saw from yesterday. So we had the API crude oil inventories last night, and for the first time after a 9-week streak of builds, we've had a headline crude oil inventory drawdown. So first drawdown after 9 weeks of builds that we've been seeing, of a fairly large nature as well, I might add. So drawdown just over 500,000. Expectations were for a build of 3.13 million. So a much more bullish outcome. Cushing though was quite bearish, was a build of 2 million. Gasoline though was bullish, drawdown of near 4 million, almost double consensus. Distillates also drawdown of 4 million. It was though the Cushing build was the largest in over 3 months, but it was the 4th weekly draw in gasoline. So on the balance, it was a bullish report, and hence then you had a bit of a further kick to fully recover the sell-off that was seen early yesterday. So that was that move. Let's have another look then and remind ourselves at why the market saw such dramatic price movement yesterday. And first of all, we had the big downtick. Now, let me just get my notes to go over exactly what it is that occurred. We had the monthly OPEC report. And as I said at the time, normally that's a report which doesn't really carry too much influence, but in the context of the market being so driven by supply and demand at the moment, particularly on the basis of these OPEC, non-OPEC cuts, these really are growing in importance. And that report basically showed two things. One, Saudi Arabia's production had increased in February to the tune of about 263,000 barrels a day, taking it back above, just a touch above 10 million barrels again, which reverses around a third of the cuts the kingdom had made in January in the wake of the OPEC agreement. Now obviously that's critical because OPEC fundamentally is the most important of all of the oil producing nations, given they by far, in terms of OPEC names, are the greatest production overall. So after overcommitting at the beginning of the year, they're now reversing that, irrespective of the price falling more recently, and last week or the week before that 10+% fall that we had. Secondly, in conjunction with OPEC also raising their forecast for non-OPEC supply growth in 2017. The last month, I think in non-OPEC supply, they've had to revise up 300,000 to 400,000. So a significant revision as US output continues to move to the upside apace. So combination of that, we saw a pretty quick sell-off in the market. And then we eventually got close to 47 before finding a bit of a floor. Then what happened was really a secondary move, where this is what I was talking about, I think, in the briefing yesterday. So the second circle on the right-hand side here, we started to see a very quick recovery. And that's because you saw a pretty rare occurrence, which was Saudi Arabia Energy Minister coming out and stating that the kingdom assures the market that it is committed and determined to stabilizing the global oil market by working closely with all other participating OPEC and non-OPEC producers. So again, this is what I mean by Saudi Arabia not actually doing anything here. If anything, they're increasing their production. But it's this verbal tactic of intervention that is enough to kind of counter the dip, if you like, if there is anything of a large degree, and particularly given the wake, if we put crude on a daily continuation, it's a phenomenally quick drop that we've had from where we were on the upper bounds of just above $55 all the way down through 50 to where we are near 47. You know, this has all happened really in the space of about a week and a half. And so unsurprising to hear Saudi Arabia stepping in to stop the rot. But what I would say is that it's almost like the boy who cried wolf. The market at some point will become disbelieving in Saudi Arabia, unless at some point probably they start committing to an extension of those cuts to production, which are due to expire in the summer of this year. So still quite a few things to look out for here in the oil space, and definitely yesterday what you saw with the gravity of both these moves, both the sell-off and the recovery, is that actually what you hadn't seen in quite a while was that it started to have quite a tight correlation and impact to the performance then of your equity markets. And so whenever you start to see crude moving in a quick fashion, and it starts to be an overall fairly quiet day when people are looking for a guide to direction, and especially when losses start mounting to $1.5, $2 on a day, certainly then that can have a read across into the various sectors and then individual stock indices as well and how they perform on the day. So it's something to keep in mind in future. 5 things I saw in the FT. They had an article this morning that was talking about 5 things to watch as oil prices fall. And I think we've covered most of this before, but these are the key things, again, just to refresh your memory, because if you hear things on these topics, you should be paying notes if you're a crude trader. 1, the shale industry. Obviously, you get those weekly US output numbers. We'll see that. We actually have that later today. Obviously, following the APIs last night, we'll get the Department of Energy's crude oil inventories at 2:30 this afternoon. Remember, an hour earlier than normal with the time difference. That US output number will be key. That was a key metric which moved the market and saw it sell off last week. Elsewhere, OPEC and their commitment to doing these production cuts, as you can see here, very much dominated by Saudi Arabia, so you can see the importance and why when they speak the market reacts accordingly very quickly. The other names really that you should be aware of if you hear them talk is Iraq, Iran, UAE and Kuwait. That's where the balance of powers lies. Gabon, Ecuador, Qatar, Libya, Algeria, Nigeria, they're all countries which you'll hear communicate quite a lot because effectively they need a much higher price of oil in order to break even with their kind of fiscal budgets. So what they say though, given the numbers we're talking about in production, carries minimal impact. Other areas, inventories, obviously following the APIs we had a surprise drawdown, first time in a long time, over 2 months. And so keep an eye on that. Fundamentally then I'd say pivot might look quite interesting as support until we get that data barring anything unexpected. And then hedge fund positioning. So investors have lined up to back OPEC cuts, amassing the biggest ever bet on rising prices in the first 2 months of the year. That's talking about net long positioning as well. So that's maybe something else to keep in mind when we get these quite dramatic volatile swings in the market, is if we keep selling off, if the market is quite heavily net long, at some point some of these funds might need to start bailing out of their position and you get a bit of a short squeeze. So hence you get quite volatile swings in the market. And then obviously the demand side is important, both on a global and in particular US economy front, given the uncertainty on the fiscal elements from Trump. So a couple of things to keep an eye on. Okay, let's move on then. Calendar-wise this morning. You have, it's just coming out, and probably I want to talk about the Fed. So we are going to get the IEA oil market report, hit the tape in a few minutes. I'll see if I can cover that live as it comes out, if there's anything significant. But later on this morning, from sterling traders, you do have the unemployment rate, claimant count change and average earnings. These typically, I'd say, would be traditionally tier 1 numbers, but really the focal point of the UK economy at the moment is, for the MPC at least, monitoring that of inflation. The unemployment rate situation is very healthy in the UK. Earnings, though, would be interesting, because what you'd want to be seeing is as inflation goes up, people's earnings also go up to negate the pressure on household incomes. However, probably that's unlikely to keep pace with inflation. And so that number probably outweighs the actual employment figures. So keep an eye on that, 9:30. But it's this afternoon where it gets much more interesting, because much like the Bank of England, the Fed, one of their key concerns is the performance of inflation and how is that tracking at the moment. And then also knock-on effect, what is the performance and the appetite of the US consumer to spend? So we'll get the retail sales report. And also we get New York Empire State Manufacturing. These are all going to hit the market at 12:30 London time. So make sure you're at your desk, prepared, ready to go for that time. That might create some short-term fluctuation in market prices. I'd probably say, unless it's a massive outlier in some of these numbers, it's unlikely to have a big directional play. because people will probably want to just trade these figures, any volatility, take advantage of that, and then await for the Fed later on in the evening. Quick look at these numbers though from the US stateside. This is the picture on the inflation front, and this is what's given the Fed a bit more enthusiasm towards turning more hawkish, and also giving the ability to hike, and not just hike in March but also think about hikes thereafter, is because this is now coming together after fairly stale inflation for a longer period of time. It continues to tick higher to a point where probably now they need to actually start to step in and start getting this rate cycle underway, which is what we're likely to see later on this evening. Retail sales has been fairly up and down, but positive on a more regular basis. And then from Empire State Manufacturing, that was a fantastic number when that last came out, 18.7. That was against market expectations of 7. So it was way higher than expected, the highest level since September 2014. All the more reason then to support this turn of becoming so hawkish to bed in this interest rate hike that we're looking out for from the Fed this evening. So with the Fed, I'm going to talk about this a lot more later on tonight, but to give you an overview, what to watch from the Fed meeting, the policy change, the needle has moved now, so to speak, and actually the interest rate hike is almost a non-event. The market is 95% priced at the moment, according to CME Group analysis of futures prices for the hike. The real question mark here, what investors are looking for, is whether the next move could come as soon as June, and whether there's a possibility of 4 increases this year, rather than the 3 predicted in December. Now, how do I know how many rate increases they're going to be? This is when people will be talking about, this is a chart you'll see a lot later on this evening, this is called the dot plots. The dot plots refers to the median forecasts of the Fed members and where they foresee interest rates on a timeline for each year, each dot defining a member of the Fed, and therefore some erring on the side of being more hawkish, i.e. they're higher, some more dovish, they're lower, i.e. they see rates on a median for that year being at a lower point than the hawkish members. The more bolded lines then are the medians as we go through the various years, and the market will be jumping on this to see whether 2017 has any sort of change. Now, a couple of interesting points from Deutsche Bank. They've said it would take 4 of the 6 policymakers currently at the median to raise their forecasts in order to bump up to 4 projected hikes from 3. This is where we lie at the moment. So we need 4 of these guys basically to bump up to join these 4 that are already there, for that bolded line to then move up to the new median here, which would mean 4, not 3 rate hikes into 2017. Now, Deutsche are suggesting that this could be a lower probability given the uncertainties over Trump's fiscal policy. So to take 4 of these policymakers to become much more hawkish might be a bit of a stretch. However, they do expect about 1 or 2 policymakers to increase their year-end 2017 Fed funds projection. And that could impact next year's median forecasts. So actually, Deutsche's chief economist believes there's roughly a 1 in 3 chance that the 2017 median dots goes up, but the 2018-2019 median dots will likely increase. So that's these ones here, this one and that one there. What's going to happen then is it's going to be very hard, I think, for Yellen to communicate what would be a dovish hike, because what I mean by that is these projections are likely to go up. So in order for it to be conveyed as a dovish hike, either we don't get this fulfilled and we don't actually get the hike occur and all the members are actually a bit more neutral. I think that's probably unlikely because the underlying metrics and health of US economy warrants them to upgrade their forecasts. Or secondly, when she holds the press conference, the way she talks about her economic assessment would be particularly dovish, in the sense that she will go, this is gradual, they'll continue to monitor the situation, they'll take into account things like Trump's plan for his budget, which is looked to be unveiled coming up shortly. And so then the market, although what the Fed does is hike and they're hawkish in their projections, she almost talks it down in the press conference. I think that's quite a logical play, which I think the Fed might follow when it comes out later today. Certainly with the statement then, that might give away a bit of the tone and sentiment, and this as well is something that you guys should have bookmarked on your browsers. This is the Fed statement tracker from the Wall Street Journal, and what essentially you can do here is click on the months. This will update automatically. You can see this is the previous one, the deck, and the changes that were made when February came out. This will basically be February here and then March here, and it will strike out the words that have been taken out, and then in green here it will highlight what's been added. So then we can determine the assessment on inflation, unemployment, and the overall economy to see how hawkish or dovish the Fed are communicating. So there's quite a lot of things that will be coming out, and it's going to be a pretty volatile event, but hopefully I'll be able to prepare you and guide you through that live when we cover it later. Okay, I'm going to leave it at that. We'll talk about this in a lot more detail in a short while. Just quickly though, having a look at oil, looks like minimal movement overall. Let me put this on a minute. Slight uptick, only about 10 cents. So having expanded by 1.6 million barrels per day in 2016, global oil product demand growth is expected to ease back to 1.4 million barrels per day in 2017, according to the IEA monthly report. Saudi Arabia raised output by 180,000 barrels per day month on month, but flows remained below its agreed target. So probably what you're getting here is the fact that the OPEC monthly report has negated, the market's kind of prepared now for that Saudi situation of them raising their output more recently. So this has been priced embedded into the market now, hence lack of really any real movement being seen here. But looking for the Fed later. So at the moment, sterling, euro dollar up on the back of a slightly weaker dollar. That move seen earlier this morning in the pound. A couple of those things we discussed. Equities on the front foot at the moment are one providing a degree of resistance in the DAX. The S&P obviously following suit, higher in sympathy. Interesting will be to watch then. I was looking at the Dow earlier. I was looking at that kind of end of 2016 into 2017 move. The two boxes defining the timelines in the move from 1,000 increments. So this was 19,000 to 20,000. It took roughly, I think, about 65, 68 odd days. And then that was halved to about 35 days when we went from 20 to 21,000. It's almost as if the market's run into a bit of fatigue from such an elevated and fast move as we came back into 2017. And we've been consolidating really in between a 250 point range between where we are lower bound there at 2781 to 21,000. And as I said, Trump to unveil, I think, his budget and Capitol Hill, or talking about it in more detail later this week, could be interesting, as well as will the Fed communication of their policy going forward. We might start to test this upper and lower bound of these near-term ranges, which will then start to get a bit more interesting in what otherwise has been fairly quiet US equity movement. Okay, guys, that's the briefing for this morning. Just to remind you, we'll be open late to cover the Fed in full later. So thanks very much, and have a good day until then. Cheers.